Hi, welcome to this episode of insuretech on VC, PE, and MA. And today I have Christopher Karachale on the show today. How are you, Chris?
I'm great. Thanks, Jeff.
Good. Webinar about QSBS and a topic, and that is now everybody very fluent with. So I was like, you know what? Let me attend this webinar. And then they brought you on to this webinar, and you are the industry expert. So I was like, you know what? There's so many insurtech founders or just, tech founders in general love building, have great ideas, but they don't know the tax systems. They don't know what's out there. And then the 30 minutes I spent listening to you talk, I was like, wow, this guy really know his stuff. So I'm going to go ahead and turn the mic over to you. And I'm going to have you tell our audience anything and everything about QSBS that they should be aware of and why it is important to engage with a professional like yourself and like your firm before they launch their startup tech company. The audience is yours.
Okay, Jeff. Well, thank you. That's great. Yeah, I mean, everybody should be thinking about tax, right? Yesterday was tax day. So if you didn't do it, if you didn't solve it by yesterday, it's too late. Anyway, okay, so as you said, so I work in this narrow little area of the tax code. QSBS is qualified small business stock. Qualified small business stock, QSBS, is a provision in the Internal Revenue Code that basically says if you have a startup, right, and you meet various requirements, and we'll go through all those requirements, right? If you have a startup and you meet various requirements, then when you sell the startup, you don't pay tax on $10 million a gain or 10 times your basis, right? So let's say I'm a founder in Silicon Valley, right? And I do an insuretech startup and I hold that startup and then it's not QSBS. I sell for $10 million, right? I pay the federal government long-term capital gain. That's about 2.4 million. Plus I got to pay California, right? 13.3%, $1.3 million. But if it's QSBS, I pay zero federal income tax, right? I don't have to pay the $2.4 million of tax. And if I'm in a conforming jurisdiction like New York, right, or a zero tax state like Florida, I pay zero, right, up and down. So my tax rate goes from 24%, 23.8% to zero. So it's a super good deal. But there's lots of requirements, right? And as you say, people normally when you're just starting out, it's hard to you're just writing code or building stuff or thinking through these problems. But it's important to kind of meet various criteria as you're going along to ensure that once you get to that exit, right, or once the VCs come in, you have the structure in place to ensure that you, as a founder, get QSBS and the early employees and investors get QSBS. Okay, so how does QSBS work? It's easy. Well, it's hard and easy, right? The rule says that if you get shares of a domestic C corporation at original issuance, when the company has less than $50 million of aggregate gross assets, and you hold those shares for 5 years, and for substantially all your holding period, all the assets are used in a qualified trade or business, then you get this tax benefit, right? You pay zero tax on up to 10 million. Or we can talk a little bit about stacking and other techniques that we see founders selling 30, 40, $80 million, paying zero, right? But again, so the rule is domestic shares of a domestic C corporation at original issuance, when the company has less than $50 million of aggregate gross assets, you got to hold those shares for 5 years, and then for substantial all your holding period, 80% of the assets that you use in qualified trade business. Okay, so domestic C corporation. I need to get shares of a domestic C corporation. So if I buy units of an LLC, or if I get shares of an S corporation, right? We form a corporation, make an S election. Those shares are not QSBS. It's got to be domestic C corporation. This is true as well. Most like the insuretech community in Palo Alto is like 25 Israelis who's created all the best insuretech companies. And all those guys came from Israel. And again, if you buy, for example, like an Israeli company, and then you reincorporate in Delaware, right, to get VC funding, you'll not get QSBS, right? Because you didn't buy domestic C corporation shares. And this goes to the second point, original issuance, right? So domestic C corporation, the original issuance requirement says You got to get the shares, the domestic C corporation shares, in exchange for cash, property, sweat equity, but not stock. Okay, so that's super important. The typical situation is the insuretech founder, starts the C corporation and just pays $200 or whatever for those shares. That's like the normal system. That's all QSBS, right? Because you've paid cash for domestic C corporation shares. Or let's say you've already produced some IP. You contribute that IP into the C corporation and take back shares, right? Like an IP contribution agreement. That's okay too, right? Or you're an early employee, right? And you get ISOs or NSOs options, right? And you exercise those options and buy them, right, in exchange for sweat equity. All those shares are QSBS, but you can't get an exchange for other stock. That's the example of the Israeli founder who starts the company in Israel and then reincorporates, and he exchanges his Israeli stock for domestic C corporation shares. Those won't ever be QSBS. The other important thing about the original issuance is you got to get the shares directly from the company. Let's say you, Jeff, are a founder, right? And you start your insuretech company, you pay cash, so you satisfy that original requirement. I come along and I buy your shares from you. Once I buy those shares, they're no longer QSBS, right? Because I didn't get them directly from the company. Okay, so does that make sense? Right? That I got to get those shares directly from the company.
Go over the last part for a second. That one went over.
Yeah. So again, what QSBS, this original issuance requirement says, you got to get the shares in exchange for cash, property, or sweat equity directly from the company, right? So you start your fintech company, your insuretech company, and you pay $200 for those shares. And you get those shares and you start your 5-year holding period to get the QSBS benefit. If I come along 3 weeks later and buy your shares from you, I don't get QSBS once I own those shares because I didn't get them directly from the company. I got them from you, a pre-existing shareholder.
Thank you for watching this video. Now a quick message from our sponsor, Mav.
Thanks, Jeff. I want to let you all in on a secret that top producing agencies don't want you to know about. If you're in P&C insurance, you know firsthand how much you're getting squeezed by your call center. It's becoming less predictable and less economically profitable to scale. But here's the thing. The top producing agencies making over $100 million are not running their leads through a human-based call center. They're running them through an AI expert like Mav to qualify, quote, and hand deliver the highest intent qualified leads to your agents. Mav takes care of the back and forth, having unlimited 24/7 conversations with your leads that are personal and relevant so you can scale to the moon. Ready to ditch your call center and 10x your agency? We're giving the listeners of InsureTech's $15,000 worth of credit to try Mav. Head to hiremav.com/InsureTechs to claim this offer.
So if the company had allocated, let's just say 20 million shares on the side,
Yep.
and then they sell that to you, you qualify.
For sure. So that's like the option pool. I'm an early employee. I can get those, right? Or I'm a venture capitalist. I come in and I buy Series A preferred stock. That's all fine too, right? The issue
So
is,
if I'm a founder and I was like, you know what, I want to take some of the top and then secondary sale, primary sale to VC first round Series A, but I want to sell some shares in the secondary to take some money out of the table. The person who buy those shares will not get the QSBS benefit.
Got it. Exactly.
Wow.
So, right? So sometimes the VCs will do the primary, right? The VCs will do the primary with the intention of getting QSBS, and they'll do a secondary knowing they're not going to get QSBS, right? But they're trying to help the founders take some money off the table. So that's exactly right. That's the hypothetical.
So basically the secondary sale automatically in the tax holding world worth 24% less.
Yep. Exactly.
Wow. Okay.
So that's it. So you got to be super careful about where you're getting those shares and how are you getting those shares, right? That's that original issuance requirement. Okay. So shares of domestic C corporation at original issuance when the company has less than $50 million of aggregate gross assets. Okay. This aggregate gross assets test is like the artificial ceiling that Congress put in place to decide what's small, right? Because remember, QSBS says qualified small business stock. And what that means, the 50 million aggregate gross assets test is where Congress just said, it's like artificially said, once you have more than 50 million of aggregate gross assets, you can't issue any more QSBS. Now, here's the important thing. Aggregate gross assets doesn't mean fair market value, right? It's defined in the code. It's the cash and the adjusted basis of the assets. So you can have like a pre-money value of $400 million for your fintech, right? But as long as you haven't raised more than 50 million, you're still okay. So, you know, you do your seed round, you get like 2 million, and then you do your series A and you get 8 million or 12 million, whatever it is, right? And you just keep counting and you get up once you have raised, in other words, once you have more than 50 million on your books, then you can't issue any more QSBS. So normally that's like the series B or the series C will take you over that limit. But it doesn't mean that you lose QSBS. All the shares that got issued before that, right? Like you got your founder shares in our hypothetical. I came in as a VC and I got my shares in the series A or the seed or whatever, right? Those shares all go along and retain their QSBS. It's just that the company is now too big to issue any more QSBS. And so that's what makes it small. The point of QSBS is to say, hey, look, if you get in at the beginning and you take all the risk and everything else associated with a startup, then you get the benefit, right? Once you come in after the company's raised 50 million, it's probably pretty assured that the company's going to make it. Does that one make sense?
Maybe I'm ahead of the podcast, but the gentleman who recently bought Boston Celtics,
Yeah,
$6.1 billion, he has a ton of technology company under his umbrella. He literally buys SaaS company for a living.
Yep.
And let's just say he have 100 company he bought, and he inherited the original allocated pool for every single company. Does that mean that he's capped at the top, or he qualified for 10 million, 10 million, 10 million, 10 million,
10 million, 10 million, 10 million. You get 10 million of each startup, right? And
under the umbrella.
Under the umbrella, right? So that's it. As long as you buy shares before the company has that 50 million of aggregate gross assets, then you potentially qualify. Now, as I say, we'll talk about ways to multiply the 10 million, but that's the base rule, okay? But you got to come in early because that makes, like from a policy standpoint, it makes sense. The whole point of QSBS is like, we want to encourage people to do startups because they fail. And if you make the moonshot and you get it, we're going to give you this tax benefit. But if the company's already pretty much going to be successful, you can't get in on that. Anyway, okay, so domestic C corporation at original issuance when the company has less than $50 million, and then you got to hold the shares for 5 years. Okay, so this is increasingly a problem, right? Because like we see AI companies like going rocket ships, right? They're selling to big companies in like 18 months or whatever, or raising huge A rounds, you know, after 9 months. But 1202 says, in order to get, this is section 1202 of the Internal Revenue Code. It says, in order to get the benefit, you need to get the shares and then hold them for 5 years. And then when you sell, you can exclude $10 million in gain. There is a parallel section, section 1045, right? Which is a deferral provision. And if you're familiar, like in the real estate context with 1031 exchanges or commercial property, it's the same idea. So 1202 is the exclusion provision. It says you hold for 5 years and you meet these other criteria, right? Then you can exclude 10 million. But section 1045 says if you sell QSBS, you hold QSBS just for 6 months, and then you sell and you reinvest in other QSBS within 60 days, you can defer the gain, but your holding period keeps clicking along. So let's say that, Jeff, you do your startup, okay? And your insuretech startup, you get the shares at original issuance for $200, all that stuff. And then you sell to Microsoft at year 3 of your holding period. You're not going to get QSBS, right? Because you haven't gotten to 5 years, right? So you're going to pay tax at 23.8% to the feds on that long-term capital gain. Let's say instead you take your $8 million and you roll it over into your next startup, Shico 2, right? And you put that in there. You only need to hold Shico 2 for 2 more years. Then you could sell that, right? And then you'd be at the 5 years. You could take that money and you could invest in another startup, your buddy startup. He's going to lose all your money, but that's theoretically what you can do. The point is, if you sell for under, if you don't get that 5 years, it's not like everything's lost. You consider whether you do that rollover with the pros and cons of knowing that, you know, you're putting that money at risk again.
Well, on the SHICO 2, you're still capped at 10 million,
That's right.
not 10 plus 10.
That's right. Your holdover, your goes like from, you're just rolling and keeping another 10 in them. Okay. So that's just like a little side point about avoiding, if you have a problem with 5 years. So Mexican C Corporation out originally issuance of the company has less than $50 million, 5 years. Okay. And then the rule says for substantially all the taxpayers holding period, 80% of the assets have to be used in a qualified trade or business. Okay. That's the last requirement. And that's like the biggest, hardest one. Because those other ones are kind of like objective. Like, you know, if you got shares, right? You didn't get off, like an option doesn't count. You got to actually exercise, get shares, or pay for shares, right? You know, if you held for 5 years, you know when you hit the 50 million. But the substantially all test is harder, right? It's important for two reasons. First, the rule says for substantially all the taxpayers holding period, 80% of the assets have to be used in a qualified trade or business. There's lots of important points in there, but two big ones are, first, it's QSBS is on an individual by individual level. For substantially all my holding period, the company might be a qualified trade or business. But for substantially all your holding period, the company might not be. In other words, QSBS is not binary. It's not like the insuretech company is or is not QSBS, but you got to really look at each shareholder and look at when did he or she get her shares? What was the company doing? Did it satisfy these various requirements over that time? It could be that you start the insuretech company and you guys are actually an insurance company, right? You're not an insuretech company. You're just selling insurance, right? Which, as we'll talk about, is probably not QSBS. And you go along and then you start to develop this technology at year 3, okay? And then I come in as an early employee and I get my shares at year 3, right? So that's my start. And then we sell at year 8. So for 5 of my years, it was an insuretech company. But for 3 of your 8 years of your holding period, it was an insurance company. So do you get, maybe I get QSBS, but you don't. The point here is you got to really look on an individual by individual basis to determine if the shares are QSBS. Oh, you're on mute.
How do we qualify it? Like, what is insurance versus insurance?
I know, that's okay. Now we're getting to the big one. This is why I have a job.
Yeah.
Okay, and so this, we say this one for last, right? So for substantial taxpayers, 80% of the assets have to use that. So what is a qualified trade or business? So 1202, section 1202E3 says a qualified trade or business is any business other than a business in like 20 listed fields: health, legal, accounting, financial services, banking, insurance, brokerage services, hotels, restaurants. There's a whole list of categories about stuff you can't be. So like that, it's the worst way to design a statute because it's like Congress said, hey, we're only going to tell you what you can't be. We're not going to tell you what you can be, right? So what's important for the insuretech community is that insurance is on that list. So is brokerage services, right? Financial services, all this stuff that's like fundamentally what insuretech is, right? However, there's the IRS has issued, and there's no good case law on this really. There's one case, Owen, that's kind of not helpful, but the IRS has issued 11 pieces of administrative guidance, right, explaining how to interpret this qualified trade or business, right? And 2 of them actually involve, one is about an insurance salesman. The guidance, when you read through it all, what it's really saying is we don't want like white collar professionals to get QSBS, right? Like doctors and lawyers and insurance salesmen and stockbrokers and everything else. They don't get QSBS, right? 1202E3 says it's this list. And it says, for any other trade or business where the principal asset of the business is the skill or the reputation of one or more of the employees, right? Like if it's based on individual skill, you don't get, like me. People hire me because I've been able to hoodwink enough people into thinking I know about QSBS, right? Or you go to your you hire your stockbroker, right? Or you go to your insurance guy, right? Because you say this guy has a good reputation about his insurance, selling the right insurance to get coverage. But there's this guidance that the IRS started issuing in 2014 makes it clear that if you're building something in one of these listed fields, it can still qualify. Right? So in 2014, we got a private letter ruling involving a pharmaceutical company. That pharmaceutical company is in the health field, right? Which is one of the listed categories. But it said this pharmaceutical company was using its manufactured assets and IP to add value to its customers' lives. In other words, it wasn't just a doctor performing medical services. The same thing is true of in 2000, I can't remember when it was, like 2020, there was a private letter ruling involving an insurance salesman. Okay. And the insurance company. And the question is, was that company involved in brokerage services? And they said this insurance salesman was not involved in brokerage services. It's interesting. They didn't actually address whether it's insurance, but they said for brokerage services, he's not simply a broker because, he does a lot of follow-up with his clients and helps explain what's going on. In other words, brokerage services for purposes of 1202 and not getting QSBS is just connecting two people. If you're just connecting two people, you don't get QSBS. Right? That's true of insurance. There's guidance that followed that was tried to sort of pare back that. But for the insuretech guys who are listening, the key is this. Like, are you just selling insurance or are you building a better way to sell insurance? Right? Like all the fintech guys that we deal with or insuretech guys, they're not insurance salesmen, they're technologists, right? And they're seeing, like I've dealt with a ton of insuretech guys, and what they're doing is basically trying to build a better mousetrap to figure out how to get me insurance, right? Like I have a terrible FICO score or whatever. What is it? FICO score? What's the insurance FICO score, right? Because whatever, because I don't pay my credit card.
FICO score.
FICO score, right? I don't actually, but let's just say it, right? But somebody builds an algorithm that searches and sees, oh, he's got an advanced degree, therefore the normal metrics to determine whether to sell him insurance don't, we're going to do this other stuff to see that maybe Christopher's worth it to sell insurance to, right? That's QSBS, right? If you're building technology to make it better. The first question I always ask when I'm talking with fintech guys or insuretech guys or you name it, medtech, I'm like, tell me about like the cool thing you built. And all of these guys, that's what they're doing. That's why the venture capitalists come in. The venture capitalists aren't investing in like insurance companies, right? PE guys maybe, right? But the VCs, they're investing in the underlying technology, right? So if you're raising money and everything else, that's QSBS, right? Okay, so that's it. You got to get shares from S-corp Corporation at original issuance, so the company has less than 50 million, hold those shares for 5 years, and then for substantial other holding period, those assets have to be used in a qualified trade business. So if you meet those criteria, then you can exclude $10 million gain. Now, let me tell you a couple of cool things to like make it even sexier. Right? There's a series of rules that allow founders of insuretech companies to stack the 10 million. So let's say I'm going to sell for 30 million. I'm going to sell my shares of the insuretech company for 30 million. If I sell, I can exclude $10 million gain, but I got to pay tax on the $20 million delta. So that would be like $5 million to the feds. If in contrast, I take my shares and I gift them to my kids, or I set up trusts for my kids, those trusts get their own bucket of 10 million because it says each taxpayer can exclude the greater 10 million or 10 times the basis of each company, right? So I give shares to the two trusts for my two kids. Then we sell, I exclude 10 million, each of the trusts exclude 10 million. So now we pay zero on the
Wow. So you have 5 kids.
Yeah.
That's 100.
Yeah. Now, of
100.
course, right. But like, do I really like you? But I got to give it away, right? Years ago, we used to push founders to really like give away as much as you can to create more buckets. But now increasingly, I'm like, you sure you really want to give it away to your bratty little kids? So there's a tension. There's a tension that you can increase tax, you can increase the sort of tax benefit by creating more buckets of 10 million, but you got to really give that away. The other one is this, and this is increasingly popular with founders, like second or third time founders. Remember, the rule says you can exclude the greater of 10 million or 10 times your basis. That basis rule generally means like what you put in. So assume I'm a founder, second time founder, and I put in $2 million into my startup, right? I can exclude the greater of 10 million or 10 times 2 million, 20 million, right? Because it's 10 times that basis, which is great, right? So then, but I've got to come up with $2 million to get that basis increase. There's a special rule, 1202I says that if you contribute IP or roll as an LLC and then convert to a C corporation, your basis is set at fair market value of the IP or of the LLC. So let's assume that you and me, Jeff, start a company. We're going to do an insuretech company, okay? And we start as an LLC, not a C corporation. That means our 5 years isn't running, right? So we're just doing it as an LLC. But it's an insuretech company, right? And then we roll out, and when the LLC is worth 30 million, right? The venture capitalists come along and say, hey, Jeff and Christopher, if you guys convert to a C corporation, we'll invest 10 million on a 30 million pre. So we convert. Our basis for QSBS is set at the fair market value of the LLC, 30 million. That means, remember, we can each exclude the greater of 10 million or 10 times our basis. So we could exclude 300 million, right? If we convert at 30 million. So this is a technique that a lot of people now in the Valley and like the New York fintech guys are trying to back into this. There's a whole lot of problems with running an LLC in the startup world, but there's a whole bunch of ways to increase QSBS like this once you get into it.
My mind's like now flying around. This was the path, and now this is the new path.
I know. Yeah, but like running an LLC, LLCs are real hard to run in the startup world. Like, what are you going to do? You can't issue options if you have an LLC.
Right.
Like you're going to go out and get a bunch of engineers and make them profits interest holders. So I think in theory, the LLC to C Corp conversion opens up the possibility of planning, but in practice, I think it's very hard unless you have a very narrow runway, and you don't start your 5-year holding period. So there's a whole bunch of potential issues to get.
What if you are acquiring these guys? These guys are coming onto your portfolio through acquisition. That's where it makes sense.
Possibly, right? You could go out as an LLC, acquire this technology, and then convert. Yeah, and do this. I think that would make sense. Is that what you're suggesting? Give me your.
So the top is C and the bottom is LLC. Why are you saying flip it around? Thank you for all your support to our channel. Here is a quick word from our sponsor. Please click on the link below in the comment section to sign up for a demo with Track AI.
What if your insurance sales conversations could work harder for you? Meet Track, your AI-powered conversation intelligence partner. Track automatically captures and analyzes every customer interaction, providing instant call summaries, risk analysis, and AI-driven coaching insights. Say goodbye to manual note-taking and hello to more selling time. Track handles the admin work while you handle the revenue. Fully integrated with your favorite platforms. Plus, get custom AI analysis tailored to your unique business needs. Transform your sales team's performance with Track. Visit track.ai today.
Click the link in the description below to schedule a demo with Track today.
It's got to be an LLC that converts to C corporation, right?
Yeah.
So you'd have to get the assets in the LLC and then convert it to a C corporation, right? But that's possible. You could get some investors come along, buy this insuretech stuff, and then convert. That would be a possibility. Oh yeah.
You work as a consultant to VCs and founders.
Yep. So I talk with founders and VCs all day long about various like all those issues that we talked about, right? Did you get an original issuance? Was it under 50 million? Is it a qualified traded business? Most of my work is kind of mid-life cycle where the insuretech folks, they've raised their B round and they come to me and they say, hey, we want to make sure that we're QSBS, right? Because we're going to have an exit in another 18 months or 2 years. So we'll do analysis of the company. I also, once the founders or the VCs have a big exit, we'll write guidance that says, hey, look, we've opined that this particular taxpayer can exclude the gain, 10 million, 20, 50, whatever it is. And that those opinion letters are helpful to protect the taxpayer from penalties.
Do you ever have a situation where you're coming late and you help clean things up before
Yeah.
exits?
Yeah, yeah. Well, it depends how late is late. Right? Like by the time you're out to year 4 or year 4.5, it's hard to solve for big problems. Let me give you an example, right? That a lot of founders, not so much anymore, but a lot of founders, someone will say, hey, you're starting this startup, make an S election, right? To have the entity taxed as an S-corp because that's tax efficient. Once you make that S election, if you make it at the beginning, you don't satisfy that original issuance requirement. Because remember, you got to get shares of a domestic C corporation at original issuance. If you make an S election, you're never getting shares of a domestic C corporation, only an S. Right? So, and then you start as an S, and then if the VCs come in, they're going to invest and blow the S election, then you'll never get QSBS because you never bought domestic C corporation shares. But let's say you start as an S and you're rolling along, and then you realize, oh man, we got to be a C corporation because we're going to get VC funding and we want to get QSBS. You can reorganize that S corporation through an F reorg or through setting up a subsidiary to actually create a subsidiary C corporation that'll get you QSBS. So there's ways to do that. Or in the insuretech community, we see guys who like start out literally as insurance sales, right? They're just selling insurance, right? Which I think is very aggressive to take the qualified trader business. But then they evolve into a C corp, into like an insuretech company. So they're no like there's insurance sales. It's a subsidiary activity of the C corporation, but the principal value of the company is this technology. In that case, we'll come in and kind of analyze this and say like, hey, look, for the first 2 years, you were really insurance, but for the 5 or 6 subsequent years, you're actually a technology company. And remember, this says for substantially all the holding period, 80% of that. So then we're looking at saying, hey, how can we show that for substantially all the founders and the early employees holding period, it was really insuretech, not just insurance.
A lot of things my mind's spinning on.
No, it's hard. But if you peel it all away, if you like, I know there's lots of rules. It's super complicated, but just like when you take away all the noise, it's really about this. If you say, do I get QSBS or not? It's like this. Are you building technology? Are you really a startup building something like to make stuff better, right? If you come up with a better way to like sell insurance or connect insurance companies and their patients or whatever, right? If you're principally a technologist, you'll get to QSBS. But if you're just providing services, then it's much harder. And so for founders thinking through this, like your audience, they should be like, well, what am I? Are we just selling insurance? You're not going to get QSBS. But if you're building technology or coming up with a better way to solve these problems, that's what QSBS is all about. If you go back to 1993, the legislative history, it says, we want to incentivize people to invest in startups because they fail. And the founders, these founders all these guys are super smart. They could have gone and worked for somebody else, but they didn't, right? They decided to build this and take that risk. That's why they get QSBS.
Well, we talk about distribution side, right? Like innovative insurance people who sell insurance through technology on a broker model. What about on the carrier side or premium financing side who build the technology as an insurance carrier or build the technology as a premium financing company?
Yeah. Well, I think the question is it right? Are they really a technology company or just a carrier?
Right.
Right. And what is the way to look at it is what is the value, right? In other words, are the venture capitalists coming along and saying, hey, we'll invest $8 million on a $32 million pre-money value, right? That pre-money value that the VCs associate with the company is indicative of like proprietary technology, right? And that's different than the sort of private equity model, which is more to roll up a bunch of companies, right? Now, I think there's a separate argument that rolling up companies in the private equity model could be QSBS, but I think it's harder to get there. But for the startups, if you're a startup and if you're getting VC funding, that's what makes you QSBS, right? The carrier model, I don't know. Are the carrier is that if those guys are going out and getting VC financing, not private equity, right? But VC financing, I think that's indicative of creating something.
Yeah. This is a fun episode. And I'm sure like a lot of my audience are tuning in, just like writing things down. And I'm gonna put your contact in the comment section, how to reach out to you. And I'm definitely gonna have you coming back on here. And maybe next time we have you come back here, we'll come up with other questions from our audience, right? And am I gonna see you on any insuretech conference this year?
I don't know. I don't think so. Nobody's invited me. If you connect me with the right people, I'll go.
Well, I think I can connect you with a few right people. So yeah, let's see what happens.
Cool.
Chris, thank you very much for coming on board. And I got a couple guys. I'm gonna send them your contact because they need to talk to you like yesterday. So thank you very much for coming on the podcast today.
Hey, it's my pleasure, Jeff. Good talking with you.